right, let's dive in. Today we're looking at, well, a classic. Winning the Loser's Game by Charles D. Ellis. It's gotten praise from some pretty big names, actually. Burton Malkiel,
Oh, yeah.
John Bogle, the founder of Vanguard.
Wow, big names.
So we know it's going to be good. We're going to try to help you guys understand how to win in the world of investing, even if it means kind of a weird idea, losing less.
Yeah, it does kind of go against our instincts, doesn't it?
It does. I mean, we're always told to,
Be better.
be better, aim high.
Right.
But Ellis, he brings up this weird thing, this paradox. He says that as professional investors get better, it actually gets harder for them to beat the market.
Consistently.
Consistently. Okay, that got my attention. Why would getting better make it harder to win?
Well, think about it this way. The playing field has changed. It's not individuals anymore. It's institutions.
Okay.
These massive pension funds, mutual funds, hedge funds, they're the ones doing most of the trading. It's not just a few smart people, in a room anymore.
Yeah.
It's a whole army of brilliant minds
Oh.
with all the latest tech, all the best information.
It's like trying to outsmart a room full of, chess grandmasters.
Yeah, exactly.
Doesn't sound easy.
No. And that's why Ellis says investment management has shifted from a winner's game, where skill basically meant you were going to win, to a loser's game,
Okay.
where not messing up is how you win.
This reminds me of, I think he uses the analogy of amateur tennis, where the person who makes the fewest mistakes wins, but he also talks about flying a plane. How does flying a plane fit into this?
Well, think about how flying has changed. It used to be all about daring, risky moves. Now it's about meticulous safety, avoiding mistakes to make sure the flight is safe.
Okay, I see.
It's that same shift that's happened in investing because of a bunch of reasons. Information's everywhere. There's these fancy analysis tools. Everyone's competing globally.
So, if I'm hearing you right, trying to beat the market, maybe not the best way to think about it. But then what am I supposed to do? Just accept being average?
Not at all. Ellis suggests something that might surprise you. Indexing.
Okay.
Basically, you invest in a broad market index fund, something that tracks like the S&P 500.
Yeah.
I know, it sounds kind of boring.
Yeah. I'm always seeing ads about beating the market. I feel like I should be finding the next big stock.
Yeah.
But okay, tell me more about this indexing thing.
Okay, so here's the interesting thing. Studies show that over the long term, these index funds, they do better than most of those actively managed funds.
Really?
Ellis calls it an unfair advantage. It's like this secret weapon that quietly wins.
I'm starting to see why everyone loves this book. What about, I know I'm not the only one who still wants to pick stocks. Does indexing mean giving up all control?
Not really. Think of it as a foundation. You build this solid core with your portfolio for steady growth over the long term, but within that, you can still allocate a little bit to stocks or specific sectors that you think are going to do well.
Oh. So I'm not completely locked in.
Yeah.
But even then, I think knowing what you're good at in investing
Right.
and how much risk you're comfortable with, that's hard.
It is, yeah.
So how do I figure that out?
Ellis talks about your sweet spot as an investor. He uses this Venn diagram, the overlapping circles. One circle is what you're actually good at in investing.
Okay.
The other is where you're comfortable emotionally, where you can stay rational.
So I got to find that overlap. That's where the magic happens.
Exactly. And this all goes back to that loser's game. If you know your sweet spot, you're less likely to chase those risky bets.
Oh, okay.
That could lose you a lot of money. Instead, you're making decisions that you're good at and that you feel good about. Less mistakes.
Yeah, and probably a lot less stress, too. But honestly, when the market's doing well, don't you kind of get caught up in the hype? And when it crashes, don't you get scared?
Yeah, of course. And that brings us to another big point. Ellis says most investors, they're too focused on returns. They should be focusing on risk.
So you're telling me managing risk is more important than chasing big returns?
Think of it this way. You can have the best offense in the world, but if your defense is weak, you're still going to lose.
Okay. Yeah.
Risk management, that's your defense. And understanding all the different types of risk, that's how you build a good defense.
So, okay, break it down for me. What kinds of investment risks are we talking about here?
Well, first there's market risk. That's just inherent to the whole market. It's the risk that the entire market goes down. And it affects everything you own, no matter how much you diversify.
So even if I spread my investments out?
Yep.
I'm still exposed to that.
It's like a tide, it
Yeah.
can lift all boats or lower them all.
Okay, that makes sense.
Mhm.
Now, what about, like, the risk of individual stocks?
Right, individual stock risk. That's where diversification really helps. Spreading your investments across different companies, different industries, even different countries.
So that don't put all your eggs in one basket.
Yeah,
That's actually really important.
exactly. But there's another layer, stock group risk.
Mhm.
Let's say you're really into tech stocks and that whole sector crashes.
Oh, okay.
Even if you own a bunch of different tech companies, you're still going to lose money.
So it's like diversification, but on a bigger scale.
Exactly. But at the end of the day, the biggest risk for most people is losing money permanently.
Yeah, that makes sense. Seeing your investments go up and down, that's one thing. But actually losing money you can't get back, that's terrifying. So how do we avoid that?
It goes back to knowing yourself. How much risk can you handle emotionally? Once you know that, you can build a portfolio that you're comfortable with, less likely to make those panic decisions
I see.
that could really hurt you in the long run.
Okay. So risk isn't something to be afraid of. It's just something to manage.
Exactly. And speaking of managing, Ellis really believes in the power of time. It's not about getting rich quick. It's about the long game.
Right. Time is your greatest ally in investing. I think I've heard that before. But I'm not always sure what it means. How does time actually impact, returns and risk?
Over the long term, investments can ride out those short-term ups and downs in the market. The overall trend historically has been upward.
He even has that character, right, Mr. Market?
Yes, Mr. Market. He represents kind of the craziness of the market. He's the guy who comes to your door every day and he's like, hey, want to buy or sell these investments at this price? It's totally random, though.
Oh, he sounds manipulative.
He can be, but here's the thing. If you're investing for the long term, you can ignore his daily moods.
Okay.
Focus on the bigger picture. Don't let his fear or his greed control your choices.
So say it again, be patient, think long term. To win against Mr. Market.
Exactly. And with more time, you can be more comfortable with stocks, which historically have had better returns than, say, bonds or cash. Even though they're more, up and down in the short term, it's about letting time and compounding do their thing.
Okay, yeah, compounding. But even with a good long-term strategy, aren't there other things that can hurt your returns? I'm thinking about fees. Those often get forgotten.
Oh, yeah. Fees can be like a silent killer.
Really?
Even if they seem small, they add up over time, and they eat away at your potential earnings.
Like a leak in your boat.
Yeah.
Small at first, but eventually sinks the whole thing.
Exactly. And that's another reason why Ellis likes index funds. They usually have much lower fees than those actively managed funds. Makes a big difference over time.
Back to indexing. It does seem to be a big theme here. But how do I pick the right mutual funds? Especially index funds. There's so many out there.
Yeah, it can be overwhelming.
It is.
But Ellis has some good advice. First, don't get tricked by past performance. Just because a fund did well last year or even the last few years.
Doesn't mean it'll keep doing well.
So those fancy numbers they advertise.
Yeah, they don't tell you the future. Instead, look for funds with low fees, of course. But also, think about the fund managers. Are they experienced? Are they trustworthy? Do they have skin in the game? Are they investing in the same funds they're managing for you?
So I gotta look beyond the surface.
Yeah.
Do some research, find funds that are well managed and fit my goals. Okay, what about 401k? A lot of people, that's like their main retirement plan.
Right. Ellis has a few key points about 401k. First, contribute as much as you can, especially if your employer matches your contributions. That's free money. Don't miss out on that.
And starting early.
Oh, absolutely. The earlier the better. Even if it's just a small amount, starting early makes a huge difference over time thanks to compounding.
I hear that a lot, starting early, starting early.
Okay, what else about 401k?
Be careful with company stock. Even if you love your company, don't put all your retirement savings in their stock.
Oh, okay.
Diversification is key.
Got it. Don't put all my eggs in one basket.
Exactly. And whenever possible, choose those low-cost index funds.
Minimize fees. Let the market do the work.
Yeah, basically. Now, Ellis doesn't just talk about making money. He also talks about what he calls the end game.
Okay.
It might seem far off, but you got to plan for the future. How are you going to transfer your wealth? It's important.
Estate planning.
Oh, exactly.
And maybe philanthropy, too. Those are kind of tough topics to think about.
They can be. But Ellis wants us to think about the long-term impact of our money, not just on ourselves, but on our families and the world around us.
So it's about having those open conversations with family about what's important to us financially And our values, too.
Yeah. And when it comes to actually transferring that wealth, he talks about different strategies like annual gifts, trusts, charitable foundations. Each one has its own, pros and cons.
Yeah. Okay, wow, we've covered a lot. From this loser's game idea to indexing, risk, even estate planning. Winning the loser's game is packed with information. But before we move on, I want to talk about something that's on everyone's mind. Risk. Specifically, financial risk.
Yeah, good point. We've talked about risk tolerance, diversification, but maybe we should dig a little deeper into the different types of risk out there, help people understand what they're up against.
Exactly. I think our listeners would really appreciate a clear breakdown of those risks
Okay.
and what they can actually do to manage them.
Okay, well, let's start with one that's making headlines a lot lately. Market risk.
Makes sense. Market risk, it's always in the news, especially with all the ups and downs we've seen recently. Can you give us a simple definition?
Sure. Market risk is basically the risk that the entire stock market, or even just certain parts of it, will go down in value. It happens because of, all sorts of things. The economy, what's going on in the world, interest rates changing, even just how people are feeling about the market.
So no matter how carefully I pick my stocks or funds,
Yeah. Right.
I'm still exposed to this overall market risk.
It's like a tide that can lift all boats or lower them all, no matter how good they are individually.
Right?
And that's why diversification is so important.
Right. Spreading your investments across different types of assets, industries, even different countries, that helps reduce the impact of those market swings. But how does this tie back to that loser's game idea?
Well, it's about recognizing that you can't control the market. Trying to perfectly time the market or predict every move, that's impossible. Focus on what you can control. Your asset allocation, your diversification, and how you react emotionally to those market swings.
So instead of trying to beat the market, I should be trying to ride the waves
Mhm.
while minimizing the damage from the inevitable storms.
Exactly. Except that market risk is part of the game, but you can manage it strategically.
Now, while we're on the topic of risk, what about interest rate risk? Everyone's talking about interest rates these days.
Yeah, that's a good one. Especially if you invest in bonds or other fixed income securities. It's the risk that when interest rates go up, the value of your bonds goes down.
Yeah, how does that work?
Imagine you buy a bond today with a 3% interest rate. Then interest rates go up and new bonds are being issued with, say, a 4% interest rate.
So my bond with the lower rate suddenly looks less appealing.
Exactly. So to attract buyers, the price of your existing bond has to go down to make up for those lower interest payments. So even though you're still getting those fixed payments from your bond, the total value of your investment has decreased.
It's like having a coupon for a discount at a store,
Mm-hmm.
but then the store announces a bigger discount, making your coupon less valuable.
Perfect analogy. And that's something to keep in mind, especially if you have a lot of your portfolio in bonds.
Okay, so how do I manage that risk? Just avoid bonds completely.
Not necessarily. Bonds still have their place, but there are ways to manage that risk. One way is to focus on bonds with shorter maturities. You get your principal back sooner, and then you can reinvest in new bonds with potentially higher interest rates.
So if I'm worried about rates going up, I should shorten the average maturity of my bond holdings.
Exactly. Another strategy is to diversify your bond holdings across different types of bonds with different maturities and different credit qualities. Helps spread out the impact of those interest rate changes.
Diversification again. Don't put all your bond eggs in one basket.
You got it. Now let's talk about another risk that can sneakily erode your savings. Inflation risk.
Oh, yeah. I've heard about inflation. It's like a hidden tax, eats away at your purchasing power over time. But how does it affect investors specifically?
Inflation is just the general increase in prices of, well, everything. A little inflation is normal, even good for the economy. But high inflation, that's bad for investors
Yeah.
because it makes your money worth less over time.
So even if my investments are doing well, if inflation is higher than my returns, I'm actually losing money.
Yeah, basically. Let's say your investments are earning 5%, but inflation is 6%. Your money is losing value, even though your portfolio looks like it's growing.
Yikes. Okay, so how do we fight this inflation monster? Should I just stuff cash under my mattress?
Definitely not. Holding too much cash actually makes you more vulnerable to inflation. You need your money to grow faster than inflation to stay ahead.
Okay, so if cash is bad, what's the solution?
Invest in things that tend to keep up with or even beat inflation, like stocks, real estate, commodities.
Things that go up in value along with prices.
Exactly. And of course, diversify, diversify, diversify.
Always diversify. It's like the golden rule of
It's
investors.
pretty fundamental.
Yeah.
Now, let's switch gears a bit.
Mhm.
What about longevity risk? This one's especially important for people who are close to retirement or already retired.
I've heard it called the risk of outliving your money. Definitely something I hear a lot of people worrying about. But what does it actually mean?
It's the risk that you'll live longer than you planned and your savings won't last. People are living longer these days, so it's a real concern for a lot of retirees.
That is a scary thought. To outlive your savings and not have enough money, later in life? What can we do about that? Just save more while we're younger.
Saving more is always good, but there are other things you can do. Working longer, even part-time, can make a big difference.
Yeah, I see. More savings and you delay those retirement withdrawals.
Exactly. And staying active, staying engaged with work can have benefits beyond just the financial ones,
Social benefits, mental benefits.
Yeah, all part of a happy retirement. Another option is an annuity.
Annuities.
Yeah, it's a financial product that gives you a guaranteed stream of income for as long as you live, no matter how long that is.
So it's like insurance against running out of money in retirement.
Exactly. Annuities can be complicated, though.
I bet.
Do your research, maybe talk to a financial advisor before you make any decisions.
Great advice. So many types of risks, so many things to think about. I guess the best approach depends on your situation, your goals, how much risk you're comfortable with.
You got it. There's no one-size-fits-all solution. But don't let fear stop you. Understand the risks, do your homework, and come up with a plan that works for you. And remember, you don't have to do it alone.
Yeah.
A good financial advisor can be a huge help.
It does help to have someone, who knows what they're doing to guide you, makes you feel more confident.
Absolutely. And winning the loser's game gives you that framework for making those smart decisions. Even when things are uncertain, it emphasizes that losing less, managing risk well, that's often how you win in the long run.
I'm really liking this losing less idea. It's not about being mediocre.
Right.
It's about playing a smarter game.
Exactly. And with that, I think we've covered some of the main points from the first part of winning the loser's game. Next time, we'll dig into some of the more specific strategies Ellis gives us. How to actually put this loser's game philosophy into practice.
Looking forward to that. We'll be back soon with more insights and advice from Charles Ellis's book. Back again for more of our deep dive into winning the loser's game with Charles D. Ellis. Last time we got into that whole loser's game concept, how not making big mistakes is key to doing well in investing. Pretty different way of thinking about it.
It is. It's about, realizing that nowadays investing is less about making these brilliant moves and more about avoiding those costly mistakes. Ellis gives us a framework for thinking about investing more strategically instead of always chasing those big wins.
Yeah. And one of those strategies, I remember this one, is building an investor's dream team. Love that analogy.
Yeah, it makes sense when you think about it. A great sports team needs a good coach, a skilled manager, dedicated players, all that. And a successful investor needs a team of pros, too. People who can help them reach their financial goals.
Okay, I like that. So who's on this dream team? Who do I need to recruit?
Well, the most important person is a good financial advisor. They're like the head coach, They help you create a plan, make smart decisions, stay on track with your goals. They're there to guide you through all the complicated stuff in the financial world.
So they're calling the plays.
Basically, yeah. But then you also need someone to handle the more technical stuff like taxes, estate planning.
Yeah, that stuff can be really confusing.
It can be. That's where a good accountant comes in. They're like the defensive coordinator, making sure you're protected, minimizing any losses. They can help you with all those details that can really make a difference in the end.
Okay, so we got the coach, the defensive coordinator.
Yeah.
Anyone else on this dream team?
Well, depending on your situation, you might need an attorney, someone who specializes in estate planning. They make sure your assets are taken care of the way you want and that your loved ones are protected.
Like the legal expert on the sidelines, making sure we're playing by the rules.
Exactly. Don't forget about insurance either. That's often overlooked.
Oh, yeah.
You need a good insurance broker. They're like the team doctor, making sure you're covered if something unexpected happens.
I like that. What if I want to give it to charity or leave a legacy beyond just my family? Do I need someone for that?
Yeah, for that, you might want a philanthropic advisor. They help you make sure your giving is aligned with your values.
Okay.
And that you're making real impact on the causes you care about.
Like the community outreach person on the team.
Right, so you're building this whole team of experts to help you achieve your goals.
Makes sense.
Hmm.
But finding the right people for this team,
Yeah.
that can't be easy. How do I know who to trust?
That's the key. Find people you trust, people who share your values. These are the people who are going to be handling your money. You got to feel good about them, their abilities, their ethics.
Yeah, it's like building any team. You want skilled players,
Mm-hmm.
but they got to be good people too.
Right. Good fit for the team. Ask around, talk to friends, family, colleagues, see who they recommend. And don't be afraid to interview a few different professionals before you choose one.
Okay, so shop around a bit. Make sure I'm getting the best players for my team. What happens once the team's assembled?
Communication. Keep them updated about your finances, your goals, anything that changes in your life.
So it's not just a one-time meeting. I got to stay in touch with the team.
Yeah, definitely. Things change, your goals might change. You got to make sure everyone's on the same page. Regular check-ins are important.
Okay, makes sense. It's an investment in itself, building that financial team. But beyond just managing money, Ellis also talks about aligning your investments with your values.
Mm.
Ethical investing. That seems to be getting really popular lately.
It is, yeah. People are realizing they can use their money to support companies that are doing good things, whether it's renewable energy, sustainable agriculture, social justice, all kinds of things.
So it's about putting your money where your mouth is, investing in what you believe in.
Exactly. And it's not just about feeling good. Studies show that companies that are, good corporate citizens, they often do better financially too.
Oh, really? So it's not a choice between doing good and making money. I can do both.
That's the exciting part. There are more and more options out there for investors who want to align their investments with their values. Mutual funds, ETFs, even individual stocks are now being screened for things like environmental impact, social responsibility, good governance. Lots of choices.
That's good to know. It makes me feel like I can actually use my investments to make a difference, not just make money.
You can. And speaking of making a difference, Ellis also talks about financial literacy.
Okay.
It's about understanding how money works, how investments work, all those basic financial concepts. It's more important than ever because the financial world is so complex.
So he's saying we got to be more proactive about managing our money, not just blindly following someone else's advice.
Exactly. And with so much information out there, it's easy to get confused. You got to be able to separate fact from fiction and make your own informed decisions.
Okay, so how do I get this financial literacy? Go back to school for a finance degree.
Not necessarily. There are tons of resources available, books, websites, online courses, workshops. There's something for everyone.
And I'm guessing having those experts on your team,
Oh, yeah.
your financial advisor, your accountant, they can be helpful too.
Absolutely. Don't be shy about asking questions, even if you think they're dumb. The more you know, the better. Less chance of making, those big mistakes. And speaking of making good choices, Ellis really emphasizes the importance of setting clear goals.
Financial goals, I mean.
Goals, yeah. If you don't know where you're going,
Right.
you'll never get there.
Exactly. Setting specific goals, measurable goals, goals that are actually achievable, relevant to your life, and have a time frame. Smart goals. Smart goals. Okay. So I got to figure out what I want to do with my money. Buy a house, retire early, leave money for my kids. Having those goals will help me make better investment decisions, keep me motivated.
Exactly. And remember, life changes, so your goals might change too. Revisit them every now and then, make adjustments.
Makes sense. So we got financial literacy, clear goals. What about our own psychology? Our emotions, our biases, how do those play into all of this? I know Ellis talks about behavioral economics. What's that all about?
Yeah, great question. Behavioral economics looks at how our emotions and biases can mess with our decision making, even when we're trying to be rational.
So even if I understand the numbers and I have good goals, my own brain can still trip me up.
It happens to everyone. We're all susceptible to these biases, like overconfidence. We think we can beat the market, even though statistically that's really hard to do. Or herd mentality, following the crowd, even when they're wrong.
Yeah.
Or loss aversion, holding on to investments that are losing money just because we don't want to admit we were wrong.
It's like having that little devil on your shoulder telling you to do the wrong thing.
Great image. But the good news is, once you understand these biases, you can start to overcome them. Ellis has some strategies for that.
Okay, what are they? How do I fight that little devil?
One of the best ways is to have a plan, a written investment plan, and stick to it, even when things get crazy in the market. That plan helps you stay focused on your long-term goals and avoid making those emotional decisions.
It's like a roadmap to guide me through the rough terrain.
Exactly. It helps you stay on track. It's also a good idea to talk to your financial advisor, get their perspective.
It can keep me grounded.
Yeah, help you make those rational decisions, especially when you're feeling stressed or scared.
Like a financial therapist. Okay, what else can I do?
Ellis also says, take the long view. Focus on what you can control.
So, not trying to time the market, not chasing hot stocks, just sticking to my plan.
Yeah.
Diversifying.
Yep.
Keeping fees low.
Uh-huh.
Letting time and compounding do their thing.
Right. Play the long game. Investing is a marathon, not a sprint. There will be ups and downs, but if you're patient, disciplined, focused on your goals, you'll get there eventually.
Patience again. That does seem to be a big part of Ellis's approach. Don't get distracted by the day-to-day noise.
Right.
Focus on the big picture.
He reminds us that the market doesn't always go up. There will be times when it goes down. But if you're patient, if you ride out those downturns, your investments will have time to recover, to grow.
Rome wasn't built in a day.
Exactly. Building wealth takes time, consistency, and a willingness to weather those storms. It's not about getting rich quick. It's about making smart choices consistently over the long term.
And letting compounding do its work. He does talk about compounding a lot. No, it's like this amazing thing.
It is.
But can you explain why it's so powerful and how it works with investing?
Compounding is basically the idea that your earnings generate their own earnings, and those earnings generate their own earnings, and so on. It's like a snowball rolling down a hill, getting bigger and bigger as it goes.
Oh, I see.
It grows exponentially over time, and the earlier you start, the more time it has to work its magic.
So even if I can only invest a little bit right now, it'll still grow into something big because of compounding.
Exactly. Start early, even if it's a small amount, and let compounding do its thing. Now, are there any other key principles Ellis highlights for long-term success?
Yeah, good question. We've talked about a lot already. Anything else stand out?
Well, one that he keeps coming back to is diversification.
Don't put all your eggs in one basket.
Exactly. Don't bet everything on one company or one industry, no matter how good it looks. But Ellis also says that diversification isn't just about avoiding risk. It's also about capturing opportunities. You're increasing your chances of benefiting from different parts of the market doing well.
So it's about minimizing losses and maximizing gains at the same time.
Right. But even with a diversified portfolio, it can be tempting to tinker with it, especially when you see some investments doing better than others.
Oh, yeah. It's hard to resist that urge.
It is. But Ellis says don't overtrade. Don't chase those short-term gains. Be disciplined. Stick to your plan. Avoid those emotional impulses that can lead to, bad decisions.
So no trying to time the market, no chasing hot stocks. Just stay the course.
Exactly. And remember, you're not going to be perfect. Everyone makes mistakes. Learn from them, adjust your strategy, and keep going.
Don't beat yourself up over it.
Right. And Ellis says, treat investing as a learning process. Don't just set it and forget it. Stay informed about what's going on in the market, new investment options, changes in the economy, all of that.
So it could be an active participant.
Yeah.
Not just a passive observer.
Exactly. The more you know, the better decisions you'll make.
Like anything else, you got to keep learning, keep improving to be successful. But at the end of the day, investing isn't just about numbers or making money. It's about achieving your goals, having a secure future, and living a life that's, meaningful to you.
That's a great point. Investing should give you the freedom to live the life you want, whether it's traveling, pursuing hobbies, or just having the flexibility to do what you love.
It's about using your money to create the life you want for yourself, for your family.
Absolutely. And winning the loser's game gives you the tools to do that. Make smart decisions, align your investments with your values, so you can not only be successful financially, but also live a more fulfilling life.
That's a powerful message and a great place to wrap up this part of our deep dive. Next time, we'll get into some more specific strategies from Ellis, how to actually put all of this into practice. Stay tuned. Welcome back to the deep dive. We're wrapping up our exploration of Winning the Loser's Game by Charles D. Ellis. It's been quite a journey. From the surprising effectiveness of indexing to building that financial dream team and understanding all those different types of financial risk.
It's a lot to take in.
It is.
But it's all really valuable stuff.
Absolutely. His book, it really challenges how we think about investing. And it gives us this refreshing perspective on how to approach it so we make fewer mistakes and have more success in the long run.
Definitely. It's a different mindset.
It
It's
is.
about letting go of that need to constantly try to beat the market.
Right, that loser's game mentality. It's not about giving up or settling for less. It's about being realistic about how hard it is to consistently outsmart the market.
Especially in today's world, yeah. It's so complex, so competitive.
Exactly. Trying to beat the market is like, I don't know, trying to climb Mount Everest in flip-flops.
Yeah, not gonna end well.
Not a good idea.
You might make a little progress,
Maybe.
but you're probably not gonna reach the summit.
That's a great analogy. And I think Ellis would appreciate that. He wants us to be more strategic, less focused on our ego,
Mm-hmm.
and more focused on the things we can actually control.
Right. Minimize those mistakes that can really
Yeah.
set us back.
Yeah.
Mm.
Play the game we can win, not the game everyone else is losing. And a big part of that is understanding the power of indexing.
It is, yeah. We've talked about indexing a lot in this deep dive.
We have.
It's really at the core of Ellis's philosophy.
It is. Can you remind us again why he's such a fan of indexing?
Sure. Indexing is basically investing in a broad market index fund.
Like those that track the S&P 500.
Yeah, exactly. You're buying a piece of the whole market instead of trying to pick individual stocks.
And that has some advantages.
Big advantages. Studies show that over time, these index funds do better than most actively managed funds.
Really? Why is that?
Well, partly because of lower fees. Index funds don't need as much active management, as much buying and selling.
So I keep more of my money.
Exactly. You're not paying those high fees to fund managers who might not even be able to beat the market anyway.
Interesting. Anything else?
Yeah, indexing also has tax advantages. And it's less stressful. You don't have to worry about whether your fund manager's making the right moves. You're just riding the market, going with the flow.
It does sound almost too good to be true. But I think a lot of people, they want to beat the market. They want to find those hidden gem stocks that are going to explode in value.
I get that. It's tempting. But Ellis says that's usually a losing game. Very few professional investors can actually beat the market consistently over time.
So instead of trying to be a hero, I should just be a team player.
Exactly. And indexing is like the ultimate team sport. You're joining forces with all these other investors, benefiting from the growth of the market as a whole.
I see. It's a more humble approach.
It is.
Less about ego.
Yeah.
And speaking of knowing yourself, Ellis also talks about self-awareness in investing.
Yeah, being honest with yourself about your risk tolerance,
Right.
your goals, what you're actually good at when it
Mhm.
comes to investing.
It's not one size fits all.
Exactly. And it's also about being aware of your own emotions. Do you panic and sell when the market drops? Do you chase those hot stocks everyone's talking about?
So understanding those psychological biases that can make us do dumb things with our money.
Yeah, and Ellis gives us some tools for managing those emotions, having a plan,
Right.
talking to a financial advisor, taking the long view.
So have a game plan and stick to it.
Exactly. And a big part of that game plan is time. Ellis really emphasizes the power of time in investing.
Yeah, time is on our side.
It is, especially when you factor in compounding. The earlier you start investing, the more time those returns have to compound and grow exponentially.
It's like planting a tree. The sooner you plant it, the bigger and stronger it'll grow over time.
Perfect analogy. Even if you can only start with a little bit, compounding can make a huge difference.
So you just got to start and be patient.
Yeah, that's the key. Consistency, patience, more than those big, risky bets.
And throughout the book, Ellis keeps coming back to this idea of aligning your investments with your values.
He does, yeah. Ethical investing is becoming more and more popular,
It is.
and it's something Ellis really believes in.
So it's about supporting companies and causes that reflect my values, my beliefs.
Exactly. And you have more options than ever before. Mutual funds, ETFs, even individual stocks are being screened for their environmental, social, and governance performance. You can find investments that match your values and potentially do well financially, too.
It's a win-win. I can make money and make a positive impact on the world.
That's the idea. And this brings us to one of the biggest takeaways from winning the loser's game. Investing isn't just about making money, it's about achieving your goals, securing your future, living a life that's true to your values.
It's about using your money as a tool to create the life you want for yourself, for your family.
That's it. And that's what Charles Ellis's book is all about. It's not just about winning in investing, it's about winning in life.
That's a great way to put it. Well, I think that brings our deep dive into winning the loser's game to a close. It's been an incredible journey exploring all of Ellis's insights. Hopefully our listeners have learned some things, gotten some good advice they can use.
Yeah, I hope so too. It's about minimizing those mistakes, playing the loser's game.
But ultimately creating a winning strategy for your life.
Exactly.
So for anyone who's looking for a new way of thinking about investing, a guide to navigate this crazy market, and a reminder that true success is about more than just beating the odds.
Hmm.
Check out Winning the Loser's Game by Charles D. Ellis.
It's a classic for a reason, and we'll have a link to the book in the show notes.
Perfect. Thanks for joining us on this deep dive. We'll see you next time for another exploration of the ideas that shape our world.